Welcome to the Taxing Subjects Podcast, brought to you by Drake Software. I'm Ryan Norton, and today I'm joined by Olena Romanchuk. She's a CPA, and she's a tax analyst with Drake Software. Welcome to the show.
Thank you for having me.
Well, we're glad to have you because today we're going to talk about the Tax Cuts and Jobs Act, and specifically how it affects S corporations and partnerships. There's been a lot of rumbling about people who currently have S corps considering moving to C corps, and a lot of that might be due to there being an easy to understand flat tax rate associated with C corps. But there's some other stuff too, like QBI. So let's just kind of jump into it. And do you think, Olena, that there will be a big migration to C corps from S corps as a result of the tax law?
Well, when you look at the headlines and read some news articles, it definitely gives you the vibe of migrating to C corporation. However, the preparers will still be doing what they were doing before, and it is performing an analysis of choice of entity. So they might reconsider the entity, but they will still do analysis. For example, they will look and see what is the future for the entity, what they plan to do with this entity, as well as what are different tax provisions and how it plays out together. Because of the efforts of lowering the tax rate for corporations, pass-through entities got the qualified business income deduction, which is essentially does the same thing. So that will be considered when performing this analysis. And also, like I said, the cases that applies to a particular company. There is a lot of changes in international law, and as we saw in 965, only S corporation shareholders were able to defer this tax. And on the other hand, there are couple deductions that are only allowed for C corporations. The AMT tax had been repealed.
Right, they're going away.
Yeah. Right, but on the other hand, it was changed for individuals as well. And as far as we can see, less people will be affected by AMT.
Speaking of QBI, if it's calculated at the individual level, what information do shareholders need this coming tax year?
Like you said, the QBI is calculated at the individual level because it depends on income of that individual. However, to be able to calculate this, they will need information that will be passed from these entities, partnerships, S corporations. So that means in terms that S corporations and partnerships, flow-through entities will need to track the information in order to pass it on. And such information includes W-2 wages and unadjusted bases and assets. And to point out, it's not like you will go and take all of your assets and look at unadjusted basis. Not all of those assets will qualify and could be grouped together in determining this amount.
Right. What are some regulations and further guidance that you think will be needed as we move into processing tax year 2018 returns?
Also, the area that needs guidance is operating income and what should be included in operating income. A lot of questions were raised about 1231 gains and whether or not that should be included in calculation for QBI. And going slightly away from the definitions, there there's no guidance or rules how to apply a QBI for tiered entities. So that will we will need some guidance on that.
Sure. Just to help get everybody ready to understand how to tackle those things specific to QBI and other similar issues. It'd be pretty handy to have that information available for
we
tax
will
pros.
need some time to sort this thing through, and maybe some more questions will be raised.
Sure. Can we talk about electing small business trusts? And first, just kind of for people who might not be aware of what an ESBT is, briefly discuss that, and then talk about some significant changes that are taking place regarding them for tax year 2018 as a result of the Tax Cuts and Jobs Act.
That was a small change, but still could be quite important. So elected small business trusts is a trust that could be a shareholder of an S corporation, and as we know, S corporation is very strict on who can be a shareholder. So what changed here for elected small business trust is who could be a beneficiary. So non-resident alien is now essentially could be the beneficiary of this trust.
Got it.
As before it was an owner.
Let's just talk about, maybe more broadly, some changes for partnerships in general. If you have any thoughts on what's coming down the pipe for partnerships in general as a result of the tax law.
Okay. I can talk about as a result of a tax law, and then I would like to bring up another point that is unrelated to the tax law.
That would be perfect.
So the major change for a partnership was this new tax law is technical termination provision, and this is gone now. So it has been repealed. And to summarize, what used to be is so before this change, if within 12 months, 50% or more of total interest in partnership capital or profit has been sold or exchanged, that was considered to be technical termination of the partnership. So what will happen, it becomes an old partnership, and then there's a deemed new partnership, and the assets will be transferred to a new partnership for exchange for the interest of this new partnership, and then this interest will be distributed to new and existing partners.
But what about some of the audit rule changes you wanted to talk about?
Right, audit rule changes. These are not a part of the new tax law, and this was a part of Bipartisan Budget Act of 2015, which the goal was to set rules in auditing partners and partnerships. So what happens with this new audit rule is the audit will be performed at the partner level, and all of the income and all of the adjustments of income, deductions or gains, and collection of taxes associated with these adjustments made by IRS will be assessed at the partnership level and collected at the partnership level. There are two methods of how to take a different approach from what I've just described. The first one will be to elect out of this rule, and that is only available for eligible small partnerships. And there is a push out method that could be elected at the partnership level. Partnership makes this election, and under this election, partners will account for adjustments made by IRS. Also along this line, I would like to bring up the importance of partnership representative,
Right.
and why partnerships need to elect one. So, partnership representative, if the name may suggest, will be acting on behalf of the partnership in case of an audit, and partnership representative have several authorities, including binding all partners in the partnership and actions with IRS. And the most important part is if partnership does not elect a representative, IRS will appoint one and elect one.
Yeah.
And know that the partnership must designate this representative each year.
So let's assume that, like, I'm in a partnership and we are bad to procrastinate, and we end up not electing a representative, and then the IRS picks one for us. Does the IRS have any guidelines about who they can pick? Is there any sort of rule stating they have to pick like an impartial person, or can they just literally pick whomever they choose?
I haven't seen any guidance on that.
Well, before we wrap up, Olena, and again, thank you for being here and talking with us about the Tax Cuts and Jobs Act and some information about S Corps and partnerships. But is there anything else you wanted to cover before we sign off for the day?
Okay, well, definitely look and track your states, because as we saw with 965, not all of the states were compliant with this federal rule. So we'll definitely need to watch for states and what's going on there. And also, there is a new credit for family and medical leave. So this business credit is up to 25% of wages paid to qualified employees for the time during which they took the medical or family leave. And the amount of this deduction is determined based on pay for the medical and family leave compared to regular pay.
Take a look into the credit for family medical leave. Consider your states. Take a look at the 965, or the section 965, and we'll leave it there for today. Thank you again for joining us, Olena.
Thank you.
That'll be it for today. We'll see you all in the next Taxing Subjects podcast.